Welcome to the Professional Trader Programme. This is where your journey to becoming a successful professional trader begins. Our goal is to provide a learning environment which allows you to develop successful trading strategies that, when implemented consistently, will lead to a rewarding trading career. Now, to give you the best possible start in building yourself a profitable trading business, our team will help you take full responsibility for your time management, study planning, and ongoing learning from this point onwards. Make no mistake, this programme is intensive, highly vocational, and designed to help you develop the practical skills required to trade successfully. We are dedicated to helping serious professional trading entrepreneurs launch their businesses and will wholeheartedly support you on your journey. Our team of experienced analysts, mentors and traders are here to act as advisory consultants as you seek to launch your new business. We will ensure that you have access to the very best training workshops, daily analysis, coaching and mentoring available, but it is you that holds the key to taking this input and applying it as advised. The programme is designed to be as interactive and enjoyable as possible. However, the early days of this process will involve some repetitive learning, mundane attention to detail, and a full commitment to mastering the routines. Those of you that take charge of their learning and by default their business from the very beginning will find themselves pleasantly surprised by just how far they have progressed by the end of the programme. Now, to enable you to get the most from the programme, we've put together this Institutional Fundamentals Study Pack, and this pack includes the following things: a list of topics for study for you to research before you begin the full programme, a video course giving you an introduction to financial markets, a reading list for your independent ongoing research, a video course teaching you the basics of FX trading, a video course teaching you how to analyse the 4 pillars of FX trading, and a self-assessment document for you to fill in and use as a gauge of how much your knowledge is improved before you begin the main programme. Developing an understanding of these topics will allow you to get far more from the programme itself, along with the other tools, sessions and coaching workshops, thus enabling you to hit the ground running. We recommend that you allocate at least 1 hour per day to this research in order to get the absolute maximum benefit from your training. Now, once you've studied the introductory material and completed the self-assessment document with success, you are ready to begin the main study programme. And then follow the daily analysis sessions while using the professional trading tools and attending the coaching workshops that we make available to you. So, take some time, digest the Institutional Fundamentals pack in its entirety, and we look forward to working with you over the coming weeks. So welcome to this first video presentation, which will introduce you to the basic concept of financial markets and, most importantly, speculation, which is our whole purpose when trading. Speculation simply means that we are trading for profit rather than any intrinsic gain or investment. Now, it's very important to understand the underlying reasons that trading exists and where we fit into the overall market as speculative traders. Although we trade for pure profit, we also serve a vital purpose to the market as a whole. And without speculators, there would be no stability in the global financial markets. Now, the futures market is where all modern forms of financial speculation began. And as the oldest form of trading, understanding this market will allow you to understand all related markets, especially FX. What we're going to do is just spend a few minutes going through some of the main concepts that you will come across and understand why they're important so that your basic knowledge is in place. So let's begin with the futures market and have a look at what it is, why it's so vital to all other markets, and then move on from there to introduce some of the foundational concepts of financial trading. A futures contract is a legally binding agreement to buy or sell a standard quantity of an underlying asset, be it a currency, an interest rate, bond, equity index, or commodity, at a future date, but at a price agreed today. Buying a future is also known as going long. The buyer has 2 choices. Number 1, take physical delivery of the product at the end of the contract. Or number 2, sell the contract before it expires for a profit or a loss. Now, selling the future is also known as going short. And the seller also has two choices. Number one, to deliver the underlying asset to the buyer, or number two, to sell the contract before it expires for a profit or a loss. It's important to note that the ease with which futures contracts can be bought, sold and exchanged is one of the main advantages. The futures market provides two absolutely vital economic functions. The first is risk transfer. The second is price discovery. So, risk transfer is also known as hedging in the trading world, and the term hedging is probably one you've at least heard. One of the main reasons the futures market, and thus speculative trading as a whole, exists is for the purposes of hedging. This means buying and selling a futures contract to offset the risks of changing prices in the underlying assets. Price risks exist in virtually every type of business. The price of crops fluctuate in relation to factors such as weather or transportation costs. Manufacturing is at risk from labour problems or tax law changes. Banks and other financial institutions are at risks due to fluctuations in the prices of underlying assets that they hold. The values of equities and bonds are constantly reacting to the forces of supply and demand and so on. Hedgers, using futures, are able to easily and efficiently transfer these risks to speculators and other hedgers. For example, a US pension fund with very large holdings of European equities fears that a short-term economic downturn in Europe. The diversity of their portfolio and sheer size of their holdings doesn't allow for a simple unwinding or selling off of their position. To counter this, they can simply enter a calculated short position on a carefully selected combination of FTSE, DAX and CAC futures, which are European indexes, which will provide a short-term hedge against the expected downturn in the share prices of their European stocks. Futures prices and cash prices tend to move in tandem since they react to the same supply and demand forces. Now, in terms of the second function of price discovery, a futures market provides a central forum for the exchange of risk at agreed upon prices. Whether the futures trades are executed on a computer screen, via an electronic exchange, or via old-style pits and trading floors, the concept's the same. The exchange of a standardised risk at an agreed-upon price. This price then becomes the benchmark for all previous and subsequent transactions for that futures contract, as well as providing an easily accessible way to price the underlying asset at a given time or day in a given quantity. The price itself becomes a valuable piece of information giving insight into the future expectations and fears of the market participants. For example, a Eurodollar is a futures contract for interest rates. Now, this is not to be confused with the Euro-US dollar currency pair, which is also called the Eurodollar. Interest rate futures are a means for companies and banks to lock in interest rates today for money it will borrowing or lending in the future. The price of the Eurodollar is determined by the market's forecast for a 3-month US LIBOR interest rate. A price of 95, for example, implies an interest rate of 5% because the benchmark price is always 100 and you simply subtract whatever the current price of the market is, and in our example the price is 95, and the remainder of what the market is what the market is expecting to be the Fed's interest rate in 3 months. So in a hypothetical scenario, the current US interest rate as set by the Federal Reserve is 3.5%. Now, the September 2015 Eurodollar, which is the futures contract for interest rates, is trading at a price of 96.40. The December 2015 is trading at 96.23, and the March 2016 is trading at 96.05. Given that the cash price should be approximately 96.50, the futures price of the later Eurodollar contract tells us that rate rises are expected and that price action in the futures is accounted for it. By December 2015, the prices are telling us that the expectation of the market is for the Fed to raise its rate to 3.75, a futures price of 96.25. By March 2016, the prices are telling us that the expectation of the market is that the Fed interest rate will be at 4%. 100 minus 4 equals 96. The futures prices are not exact for a number of reasons, which we'll look at later in your training. Now, because every transaction involves a buyer and a seller, each transacted price is a result of two different parties having an opposing view that the prices are reasonable for a trade. This is a vital thing to bear in mind when entering a trade. Do you really think it's a good and reasonable price based on your overall view of the market and the reasons for taking the trade? Now, speculators, which of course are you and I, fulfill several vital functions as they facilitate the marketing and trade of futures. Speculators don't create risk, they actually assume the risk from hedgers and other market participants in the hope of making a profit from subsequent market fluctuations. For example, a large bank, we'll call it Bank A, has 50 euro-dollar contracts to sell in order to cover some risk on their outstanding debt. And they're only prepared to sell at 94.25. Bank B wants to buy 50 euro-dollar contracts but will only pay 94.15. Speculator X thinks that the Fed will be cutting interest rates in the near term, so is prepared to pay 94.20 for those euro-dollar contracts. Meanwhile, speculator Y is convinced that there are no rate cuts coming anytime soon, so is willing to sell euro-dollar contracts at 94.22. What's happened in this hypothetical scenario is that there was previously a wide market, i.e. 94.15 buy price, 94.25 sell price. But thanks to the speculators, the prices are now 94.20 buy and 94.22 sell. Both hedgers, the banks, have had significant improvements in the price gap in which they would have otherwise been forced to make a much worse deal. What the speculator has done is provide crucial liquidity. In a market without these risk takers, it would be almost impossible for other participants to agree on a price because sellers want the highest price, buyers want the lowest. It would not be cost or time efficient to find offsetting hedgers, so speculators bridge this gap between bids and offers, thus making the market much more efficient and competitive. In short, speculators increase the number of ready buyers and sellers. Now, we're going to look at the concept of risk, and risk can be defined as the exposure to mischance. So in investment terms, it's the possibility that one will lose money. This possibility is higher when the returns are greater. There are two types of risk: specific risk, risk specific to a particular investment, and non-specific risk, which are risks present in all portfolios of investment, basically general market risks. Now, a primary feature of futures is that they can be used to diversify away from risk in an efficient manner with lower transaction costs. For example, in FX markets, currency risks can be hedged with currency futures. And in the stock market, portfolios of stocks, as we looked at in our example, can be hedged with index futures such as the FTSE, the S&P, the DAX, etc. Futures are one of the first methods used in the concept of risk management, which is why it's so popular and vital in all of its modern forms. Now, the next concept we're going to introduce is leverage. Another primary feature of futures contracts is the leverage that occurs. For a small sum on deposit, known as the margin, a trader can control a significantly greater valued asset. Measured as a percentage of the capital invested, the profit or loss potential on a futures contract is much greater than a similar investment in the actual underlying asset itself. So, for example, to hold a representative basket of stock in the FTSE 100 index, trading at a price of £54.50 would require holding physical stock at a cost of £54,000, 500. To hold one FTSE futures contract requires an initial deposit of just £3,000. A 5% gain in the price of FTSE would give the shareholder and the futures trader a gain of £2,725. The percentage return is significantly different. The shareholder has a 5% return on capital invested, while the trader has a 90% return. Of course, this works the same for losses too. Now, we will look at a term you've probably at least heard before, and that is liquidity. The term liquidity refers to how difficult or easy it is to trade a particular market without changing the price significantly, and in a quantity that suits your purpose. A liquid market has large numbers of buyers and sellers and very small buy-sell spreads. Now, liquidity changes depending on various factors. For example, during holiday periods, most traders and speculators are away from their desks, which creates low liquidity environment, which in turn makes the price moves much more volatile and the spreads higher. In FX, high impact news events create a similar environment as everyone stands on the sidelines waiting for the release. Understanding liquidity and why it's important will protect you from entering the market at dangerously illiquid times when you're unlikely to get the price you want and will pay a far higher spread. Now, when trading, you will do so on something called contracts. Each market and exchange designs these contracts to meet the needs of the market participants as a whole. So for a futures contract to trade successfully, it must appeal to a broad range of market users, institutions, individuals, hedgers, and speculators. This is set by the exchange at a suitable level to generate liquidity. For example, a standard contract or lot in FX is 100,000 units of whatever currency is being traded. This can be broken down further in the spot market to units of 10,000 and 1,000, and this is mostly to accommodate the growing number of smaller retail traders. In futures and other markets, the minimum fluctuation in price is called a tick, and a tick represents the minimum up or down movement in a contract. The FX markets use the term pip, percentage in point, which is a different word for basically describing the same thing. So for example, the FTSE tick is 0.5 of an index point, so the price of 5452.0 can be followed by 5452.5 or 5451.5 and so on. The tick in the Schatz is 0.1, so the price of 102.34 can be followed by 102.33 or 102.35 and so on. The tick value is the monetary value assigned to a tick. The profit or loss on any futures contract is translated into movement in ticks multiplied by the tick value. So for example, a pip value in FX on a standard Euro-US dollar contract, which is 100,000 units, is roughly $10. So if you're buying one standard contract of Euro-dollar on the FX market and you make 3 pips profit, then this equates to roughly $30 banked. If you buy 10 contracts and make 3 pips, then your profit is roughly $300 and so on. Financial markets coincide with the quarters of March, June, September and December. These delivery dates are set on a particular day in the month or potentially over a period of days through the month. The last trading day is set by the exchange on a particular day of the month. Now each market has a different date, but it's usually around the end of the month. Now, unlike in FX, the clearing and settlement of exchange-traded futures is highly centralised, and clearing houses fulfil 2 important roles. Number 1, the clearing house becomes the legal counterparty to the original transaction. Number 2, the clearing house guarantees the performance of contracts. In other words, the clearing house is the seller to all buyers and the buyer to all sellers. There are 3 distinct roles in the clearing process. So you've got clearing house, you've got clearing member, and then you've got non-clearing member. Now, the clearing house is the administrative centre that coordinates delivery and settlement. Clearing members are members of the relevant exchange who are authorised to clear business. Clearing members need substantial capital resources and tend to be like big brokers, investment banks. Non-clearing members are much smaller entities such as traders who do not satisfy the capital requirements for clearing membership. They gain access to the clearing system by using the services of a clearing member. Now, we briefly mentioned earlier the concept of margin, and there are 2 types of margin in trading. The first type is initial margin. The second type is something called variation margin. Now, initial margin is a returnable good faith deposit paid in cash or collateral required from all those entering into a contract on the exchange. The amount of initial margin may vary subject to market volatility. If the market suddenly becomes highly volatile, additional margin may be called at short notice intraday margin. Initial margin is due to the clearinghouse immediately after a position is opened. The clearing member thus usually requires that the margin be in place before that position is opened. Now, variation margin represents the profit loss on an open position each day. At the close of each day's trading, a settlement value is assigned to each contract. The clearing house calculates the profit and loss for each position for that day based upon the net movement from the previous day's statement. The vast majority of futures contracts never go all the way to the point of delivery and are closed out with an offsetting trade in the market. Those positions that are still open at the expiration of trading will be fulfilled by cash settlement or physical delivery. With physical delivery, a feature of all futures markets is that delivery is the option of the seller. The short may determine any time during the delivery period that it will issue a notice of intention to deliver. The amount of money paid by the buyer to the seller for delivery is fixed by the exchange on the delivery day. This is the exchange delivery settlement price, or EDSP. The EDSP is a figure determined by the exchange and is often an average of prices set over a fixed period of time. Physical delivery exists for most bond and commodity futures. With cash settlement, many contracts such as equity index products and short-term interest rates are cash settled. No physical delivery takes place. Contracts are closed out against the EDSP and cash changes hands as a variation margin from the settlement of the previous day. As we looked at earlier, short-term interest rate products, remember Euro-Dollar, short sterling and Euro-Swiss are examples of this, are futures based on the rate at which banks trade instruments in their corresponding denominated currency, especially the rate at which banks will lend and borrow money from each other for upcoming 1 month and 3 month periods. The cash market is also an important concept to understand because you will constantly hear this referenced in your daily research and analysis. Money market instruments traded in the underlying cash markets are debt instruments with typically 12 or fewer months to maturity. And these include fixed deposits, certificates of deposit, bankers' acceptances, commercial paper, repos, treasury bills, and so on. In the cash market, we can also have the concept of fixed income securities such as bonds. Now, a bond is a loan document that bears interest. Think of it like a sophisticated IOU. Bonds are issued by companies, governments and other supranational organisations basically to just raise money. So bonds are categorised according to their lifetime, issuer, interest payment details, credit rating and other factors. Fixed income bonds bear a fixed interest rate payment called the coupon, which is based on the nominal value of the bond. These interest payments are either annual or semi-annual. The bond futures that we look at as an example are based on a basket of government-issued fixed income bonds. For pricing purposes, government-issued bonds are considered to be free from default risk. So bonds naturally become the benchmark for the pricing of risk in all other financial assets. Now, bond yields are dependent upon the issuer's creditworthiness and the remaining lifetime of the issue. Now again, since the futures we look at are all based on government debt, creditworthiness can be dropped from the equation. The correlation we will look at is between yield and remaining lifetime. This mathematical function is known as the yield curve. Bonds with a longer remaining lifetime tend to yield more than those with a shorter remaining lifetime. This is a normal yield curve. A flat yield curve is where all the remaining lifetimes have the same rate of interest, and an inverted yield curve is where longer dated bonds yield a lesser rate of interest. A yield curve is a picture of where interest rates are today. To some, it's also a picture of where interest rates will be in the future. The yield curve shows the rate of return that can be locked in now for various terms into the future. The investments to construct a yield curve should all have the same risk, the same features and the same coupon rate. To construct a yield curve of German government bonds of varying coupon rates, for instance, the variance in those coupon rates, or the variance, can be factored out so that the price is comparable. Now, there are 4 basic shapes of yield curves you're going to need to learn. The first one is the normal yield curve, and it's characterised by nearby yields being lower than further dated yields and progressing from the shortest dated, lowest yield to longest dated, highest yield in a relatively smooth curve. An inverted yield curve is shorter dated investments yielding more than longer dated yields. Once again, the yield process, relatively smooth curve. Typically, a yield curve is only inverted rarely and for a short period of time. A flat yield curve indicates that yields for short, medium and long-term investments are all approximately the same. And finally, a humped yield curve is characterised by increasingly higher yields for the first few periods and then lower yields for longer holding periods. Now, to go along with this, there are also 3 basic explanations for yield curves. The first one is the liquidity preferences hypothesis. Investors dislike having their money tied up and demand extra return for longer holding periods. The longer the person has to defer current consumption, the more marginal compensation they demand. Investors prefer liquidity and will accept a lower return to get it. The second one is the expectations hypothesis. The yield curve is a picture of what people expect rates to be in the future. For example, a humped yield curve with a peak at 2 years out means that people generally expect interest rates to rise for 2 years, after which they will then trend down again. And the final one is market segment hypothesis. This is based on the idea that there is not one continuous debt market, but several discrete segments with different players in each segment. For example, the short-term market is dominated by banks and money market dealers who, through very competitive supply and demand, arrive at a series of short-term interest rates. A second market segment, including mutual funds, corporations and casualty insurers, typically only borrow and invest in the mid-term. The long-term market is most influenced by businesses with long-term projects and liabilities like pension funds, life insurance and property companies, which vie with each other to set rates in the long end of the market. So, now we've looked at the most basic concepts, we'll begin our journey towards the FX market specifically with a look at fundamental analysis.